evening, realistic on growth, ambitious on inflation, prudent on fiscal deficit, and a tad greedy on rate cuts. That is a crux of the economic survey for the coming fiscal year that was tabled in Parliament. This is the second survey under the Chief Economic Advisor Arvind Subramanian. Here are the top 6 highlights. First, the survey has pegged the growth rate for FY17 between 7 and 7.75%. It also warns of downside risk to the medium-term growth rate and has clearly stated that 8% growth will have to wait for 2 years. So double-digit growth rate at this stage is just a pipe dream. Second, inflation in FY17 is being pegged at between 4.5% to 5%. The survey expects the central banks to meet its 5% inflation target for FY17. With the 7th Pay Commission looming, the inflation target is uphill to say the least, but the survey says the Pay Commission will not destabilize prices. Third, the survey admits FY17 will be a fiscally challenging year. It expects a 3.9% deficit target. It also argues that India must stick to the 3.5% target set for FY17 to maintain credibility. Fourth, the survey is batting for more rate cuts from the central bank. It says that effective stance of the monetary policy could be relaxed. Fifth, the survey calls on the centre to widen the tax net from the current 5.5% to over 20%. The survey also says that the super rich in the 20 to 30% tax bracket are betting maximum tax breaks and has asked the government not to raise the income tax exemption limit to 3 lakh rupees. And finally, the survey raises the red flag about substantial leakages from the government's subsidy kitty. It pegs that 1 lakh crore rupees in subsidies are going to the well-off. The subsidy bill for FY17 big bet at 2% of GDP. Here's the man behind that survey.
In terms of the number of taxpayers, individual income taxpayers, we do seem to be an outlier, and our kind of rough, crude estimates suggest that, the ratio of taxpayers to voters in India is 4%, and we kind of crudely estimate that it should be something like 23% for a country at its level of economic development. There are some solutions, like, for example, on the right-hand side, you see the top chart is exemption limits. They've been rising very steadily, much faster than, per capita GDP has been growing. So one low-hanging fruit is, just not to increase exemption limits and allow natural increases in income of those to come into the tax net, and that's a way for increasing the number of taxpayers. It turns out that we also are very generous to the well-off. In this chapter, for example, we analyzed 7 areas where the well-off are subsidized, and these are listed here. And it turns out just from these 7 policies or schemes, we provide 1 lakh crore in kind of bounties to the very well-off. So this is a question that I think needs to be addressed at some point in time. In India, the people who benefit from tax exemptions are not the middle class, are not the rich, they are the mega rich, because the 10% tax bracket, the lowest tax bracket, starts at the top 5.8 percentile of income distribution. The 30% tax bracket, only 0.5% of all Indians, earning Indians are in that tax bracket. So when we think about tax exemptions and tax benefits in India, please keep this in mind that, we're not talking middle class, but we're talking very, very, very rich.
Full marks to the economic survey. They've been realistic, and I think the 3.5% will be music to the bond markets ears. The bond markets had a very rough couple of months. I think this will be a positive surprise because markets had basically priced in some slippage. So there will be a surprise here. I think the question is going to be how this gets done. You would hope that the 3.5 is accompanied with realistic assumptions on the tax side, and it's done because some part of the pay commission is pushed out, which is what happened in the rail budget. Our sense on the rail budget was you did have some special allowances that were pushed out, which ties in with Pranjal's point. So to the extent that some of these wages are pushed out, you reach a number of 3.5, very, very positive.
It's a very fantastic growth number, very realistic, very credible, something between 7 and 7.5. We are ourselves at 7.4, flattish growth compared to last year. So we are happy to see this number here. Moving on to inflation, inflation of 4.5 to 5 looks quite low to us. Even if they meet the 5% target by March 2017, the average of the year inflation could be much higher. I think it could be somewhere in the 5.5% range. Speculating a bit, reading between the lines, it could mean that the government is probably not going to have the HRA allowances this year. Maybe they'll defer it to next year.